Morning everyone, my name is Richards and I'm head of investment partnerships at SeedLegals. Got to say thanks for having the legal session early in the morning. People have had some coffee, I'm hoping people are feeling energised. But the key thing is here, we're not going to be getting really used to technical. This is a far more commercial thing. That's the whole purpose of SeedLegals, I would say. For those of you who aren't aware, what SeedLegals is, we've been going on for about 5 years. And what we are is we're not a law firm, we are in fact a law tech platform. And what we've become for about 30,000 startups now in the UK, we are effectively the legal operating platform for their businesses. So I speak as this as an ex-advisor. I used to work as an accountant in the city. A lot of these things these guys do at several £100 an hour is actually often very manual, repeatable work. So what SeedLegals has done is taken a lot of those things. So for example, doing the legals for your funding round, setting up your EMI option scheme for your employees, sorting your R&D tax code. We've taken all that and we've automated it. And what that means essentially for founders, it means that basically a lot of their time is now saved by not being burdened by these administrative tasks and being able to focus on their business. So it means these things get done quicker, and it means that overall, you're saving up to about 80% in terms of fees that you would when you go with traditional advisors. So that's about what SeedLegals does. As I say, I'm the head of investment partnerships. Lily, sorry, let me just please introduce yourself.
Hi, I'm Lily. I'm on the account management team at SeedLegals. So I literally spend every day, morning to evening, speaking to founders, helping them plan investment rounds, helping them plan EMI schemes, and basically making it as seamless as possible, but also as kind of strategically advantageous as possible as well. So yeah, that's what Nick and I wanted to talk through today. Like, how can you actually use the legals to your advantage? So rather than
I said the left, I pressed the left. That hasn't gone the right way, so I'm going to try right.
So rather than using it as simply just the administrative, it needs to be done side of things, actually making it work for you and speed things up and actually make your life a little bit better and your startup a little bit more efficient.
Indeed, and just to give you guys a sense of scale, as I say, we've been going 5 years now. SeedLegals is now the largest closed funding rounds in the UK. We do about 300 funding rounds a quarter, so that gives you a sense of all the founders that Lily and the team have got 100 now at SeedLegals are speaking to on a daily basis. So, Lily, we'll go on to the quick agenda for what we're going to do.
Yes, so today we just wanted to run through a few basics, but of course open the floor to questions throughout, so if anything you'd like clarification on, just put your hand up. But basically we looked at the SEIS, EIS, which are the tax incentive schemes, getting your house in order, so basically the things you need fundamentally done before you even start speaking to capital. Terms, what are they, what should they be, what should you look out for, and how to structure a raise. So as I was mentioning earlier, things like safe agreements is a bit of a weird thing to say because the A means agreement, but yeah, and different ways that you can approach it and nail it.
Indeed. We won't be talking about future earnings agreements. Obviously, that is a new interesting emerging way of finance. We're going to stick to the more traditional ones for today. Cool. So, apologies, I am looking at this slide from the thing, but thanks for that. I can remember a lot of it. So, if you're a founder here today, or even if you're perhaps an advisor helping out a startup here, I think if you are UK-based, or even if you're overseas and have a significant UK presence, and that can literally just mean having an employee, based in the UK who can make key decisions for you, or maybe have a few people working in the office. It's really, really important, in my view, to be aware of SEIS and EIS. So these are the enterprise investment schemes set up by the UK government. The UK, in my view, is extremely, extremely lucky to have these things. Why is that? It's because it's very, very much encouraging investors to invest in your business. What it does is mainly for individuals who do this, invest into your business, and to some extent funds which can invest under the SEIS and EIS schemes. It basically gives them a ridiculously significant tax advantage when it comes to investing in your business. Now, depending on the scheme, I'm not doing the exact maths here, but effectively, if they invest £1,000, depending on the scheme they get, they can say they can get immediately anywhere between 30 to 50% of their money back, so that automatically de-risks the investment to some extent. If your startup goes under, which, hey, obviously we hope it doesn't, but that's a reality for many startups, the investor again can recoup some further money back in tax. And then also, if it is successful and they hold it for the kind of right amount of time, if there's an exit, they'll also benefit from reduced capital gains tax. So this is, this is a ridiculously lucky thing. I think we have in the UK. This is the lifeblood of the pre-seed and seed ecosystem in the UK. So basically, what am I getting at here? If you're a startup and you are eligible for this, don't ask me who's eligible or not. I know that generally many people are. If you've got questions on that, just go on to SeedLegals. But the key thing is to say, we are extremely lucky to have this in the UK, and you should definitely consider it. And as I said, if you're an overseas company as well, there's also ways you can potentially raise under the scheme as well. So why should you do this? Well, the reason why you should do it is because if you are a startup looking to raise cash, this is all a numbers game. You could easily speak to 100 investors when it comes to doing a funding round. And hey, not everyone is going to get your idea. There have been people who have rejected Stripe and the Googles of this world. Everyone rejects people. So it is very much of a numbers game. Think of it like your funnel. If you have SEIS and EIS, that is definitely, if you're raising in the UK, going to widen your potential investors to reach out to the top of the funnel. And of course, you can go through the DD process, loads of questions. And ultimately, you get more people at the bottom of the funnel, which is people who give you the money. So if you can get it, do it. I would definitely recommend doing it. It's a relatively inexpensive thing to do in terms of the benefit of that cost. It's 1,000 times multiple, I would say. So in terms of how you do that, I mean, effectively, you can just, if you feel comfortable enough, you can kind of look at HMRC rules and say, oh yeah, I qualify for this, raise investment, and then just simply write up to HMRC saying, I would like to now claim CIS or EIS for my investors. The problem with that, though, is if you are wrong and HMRC rejects you, then obviously that can be a very awkward and difficult conversation with your investors, particularly for angels. For a lot of angels, this is crucial for them to invest in a startup. So what you can do to mitigate that risk is you can apply for what's an advance assurance, and that's basically where you basically submit a form to HMRC with your business plan, which effectively says to HMRC, please can you certify that my business will be eligible for SEIS and EIS. They effectively give you a certificate, and then that effectively is almost kind of like, hey, in COVID terminology, your COVID passport that says I am eligible for EIS and SEIS, and your investors now have a lot more comfort when it comes to investing in your business. For a lot of angels, they aren't going to invest unless they see this. There are some people who might be a bit more lax about this, but I can tell you a lot of angels, and even more specifically, any SEIS or EIS fund, they are absolutely going to see this. You can do this on SeedLegals, by the way, for literally a couple of £100. But what I would also say is, if you are looking to go out and raise, start this now. It can take up to 6 weeks for HMRC to process applications. I don't know the exact stats, but I think literally HMRC process thousands of these applications a year, and I think SeedLegals now does about 1 in 6 or 1 in 4 of those applications. So just always make sure you have that time buffer, because obviously that document is what could be the make or break between you getting that investment or not.
It's funny you say certificate. It literally is just an email from HMRC, and so a lot of people come back and go, have I got it? Is this it? They're forming an email. I'm like, yeah, no, that's it. And that's all you need.
Cool. Okay, so now to Lily, talk about getting house.
Yeah, so there are a few things really that you should have in place on top of advanced assurance, and ideally probably before that as well. So getting your house in order is always important. I think number one is the cap table. So if there is any kind of outstanding equity in terms of issuing shares to a co-founder, setting up an options pool if you need to, a lot of different things. The cap table essentially needs to be as accurate as possible before you then start speaking with investors, because really what you're going to do is when you do send them terms or start talking about dilution, etc., is they need to know exactly what it's going to look like post their investment as well. So if the cap table isn't accurate, that can lead to a whole host of problems down the line, especially if it's something that's not easily spottable. That can lead to a lot of RPO frauds, which is a change filing at company's house, way into the future, which causes a lot of issues. So to be avoided, making sure that your cap table is up to scratch. And then we have something called founder service agreements. I realize this is all one.
Yeah, I mean, the Google slides are powerful.
So yeah, then we have something called a founder service agreement. Now, this is super important, especially if there are 2 founders, but important full stop. Essentially, this is like an employment contract for a founder with their own business. And really what it does is it outlines the relationship with the founder, with their equity, and basically how they earn it. So I don't know how many people are familiar with vesting and share option pools. So you can grant shares to employees and they would earn them over a period of time, and then they have the option to buy them. Now with founders, you can't really do that because they already own the whole business. But a lot of investors want to see that the founder's going to stick around, because what's going to stop you from taking in £1 million and being like, you know what, I don't want to work here anymore, I'm going to leave. So we have founder service agreements. So especially if you have a co-founder, this is a super, sometimes awkward but important conversation to have with each other. Who holds what equity? What is the vesting period? And so essentially how it works with reverse vesting is, let's say you earn your equity over 5 years. If you walk away at any given time, we're essentially working into your articles of association down the line. If I walk away, I will sell back X amount of shares to the business at a nominal fee. That way, you know, your investors, other team members, other co-founders are protected in the event that, you know, sometimes people just need to move across the world for a partner or whatever, like life happens. This is the best way to mitigate any problems down the line. And a lot of funds and investors would expect to have this in place before they invest in you as well. So
particularly at the pre-seed and seed space, because at this stage, so much of the value is not on the business, it's actually on you as a person. So yeah, this agreement, I suppose, is kind of very much protecting that people risk for the investors and for the company.
You're irreplaceable. So then we have IP assignments. So this is intellectual property assignments. So this is super important, especially if you have any third parties working on your IP. So a lot of early stage startups will have third parties working on their tech, graphics, all sorts. Now, if you don't own your IP, again, investors will have a lot of question marks, because that could be something that is then being sold to other businesses, provided elsewhere. So any contractor, etc., really should be signing an IP assignment if they've not got an employment agreement, because that's baked in, worth noting. But yeah, any IP that's created for you should be assigned to you. Again, you can do this on SeedLegals with a subscription. It's super simple, and the team would help, but basically, yeah, that's key. So any contractors anywhere in the world, so long as it's an IP assignment, UK law, if we're talking about the UK, it works. And then we have the term sheet. Now, Nick's going to go into more detail on this, but I think something we kind of strongly agree on and feel is that it's really important that you know what's going into your round legally. So I'm going to let Nick explain what the term sheet is.
Sure, absolutely. So there's an interesting comment actually in the earlier talk about sort of waiting for term sheets from investors, which almost kind of implies, you know, you're sitting there playing the waiting game, you don't know what to expect. But really, you know, for founders, I would very much encourage for you to be aware of it, you know, really aware of what this concept is, and also kind of digging into the detail within it. So look, I mean, I'm sure a lot of people know here in this room, but if they don't already, the term sheet really is going to be the key document to start this round. This is where negotiations begin, and ultimately what this document's focusing on is the most important terms. So I'm sure people here will probably, you know, if you have ideas about a term sheet, you probably think, okay, yeah, fine, it's going to contain the valuation, it's going to contain how much money they're going to put in, but, you know, have you thought about, for example, you know, what about vesting of your shares? Do you own all your shares from day one, or do you have to own them over time? How much can be paid as a founder? How much control is the investor going to have over your business? Are they able to veto anything? These are important decisions, and well, I suppose factors that you need to decide now. The key thing to note with all of this is that this term sheet is completely non-legally binding, but nonetheless it is going to be, I think, one of the most pivotal moments in the funding round. One thing we would flag as well, but we'll go into this a bit later, is that, you know, generally speaking, as a concept, a lot of term sheets are fairly similar, but they will vary slightly depending on the instrument you're using. So, for example, if you're using a convertible instrument, we put the abbreviations there, ASA, which is an advanced subscription, which we'll talk about later, or a CLN, which is a convertible loan note. Those will look slightly different to the standard equity round. But I think the other thing to be aware of as well is when you are looking at term sheets, anything you're looking at, there's two important concepts you must be thinking about every time. This is either going to relate to economics or controls. Every time you're looking about a term, that's what the investor is wanting to control to some extent, the economic outcome for them, and also the control or mitigating that risk. So they're proposing that to you, but likewise, you should think the same. What does this term economically mean for me? In terms of control, how is this term going to affect the running of my business and also my life as well? So we've just put some examples there of key clauses you expect to cover: valuation, share class, warranties. You can, by the way, you can explore all of this on SeedLegals, which actually brings me on to my next point. So look, I used to work in VC, and I think several years ago, I say it was very much kind of a waiting game for founders. You kind of go out and court investors, and you hope to get a term sheet from someone. But what I've been delighted to see, and I think without sounding too polite, I think SeedLegals helped drive this change a bit. I think technology has actually changed the game here for founders. Basically, with resources like SeedLegals, what you can do now is you can use data to drive decisions. So at SeedLegals, as I mentioned, we're the largest closed funding house in the UK. And unlike a law firm, the beauty of what our platform does is all of contracts for rounds are generated on our platform. So we can see automatically for, say, a funding round of, say, 300K versus 3 million one. When you have multiple of those rounds stacked, you begin to see patterns of what is common in, say, an angel-led round and, say, like a VC-led round. So what you can do on SeedLegals is you can come on and you can basically educate yourself on the terms in a very simple way. Understand what the market standard is. Previously, you would have either had to be an ex-lawyer perhaps and be familiar with these things, have a mate who's a lawyer, or go on the BVCA website and basically try and understand these things, which, although the BVCA does good things, it's not necessarily most user-friendly in that respect. So what you can do as a founder now is you can now empower yourself. You can educate yourself on those terms, and effectively you bring the terms to market. You don't have to wait for an investor to do that. And I think this is what Lily's team at SeedLegals does, and sort of very much encourages to founders is, don't hang around. Funding rounds are all about momentum. And either you can build a term sheet and take it to founder. It's showing actually a lot of really important things which I think are crucial to how an investor perceives you during the round. Got to remember that as well, particularly in the pre-seed and seed round, as I said earlier, they don't actually have much to go on. They've got your idea, they think it's interesting, they know the competition, they can see your financials, which obviously everyone takes with a pinch of salt. What they've got the most control of at the moment is their perception of you and your ability as a founder. So you coming in with a term sheet, what does that show them? These are micro data points, but hey, I like to think of British cycle in margin gains. When you're coming with a term sheet in reasonable terms, you're showing you're a competent entrepreneur already. You're term savvy. You know what you're talking about. You're taking this control of this process, and thus you're increasing confidence of your investor. It shows as well that you're ready to do the deal. The funny thing is that I think that, say, in the previous days, founders would wait for term sheets and you think, this is it. Now things are starting. Well, why can't you flip that on its head and effectively, say, drive the momentum yourself? Funding rounds, I think any form of fundraising actually, whether you're a startup or whether you're raising 4 billion private equity funds, an old boss of mine used to say actually, he said it's all about momentum. It's all about driving people to decisions. And when you have a term sheet, if I'm an investor, I actually remember occasionally it wouldn't happen in the old days when I was working on deals, but when a founder did come with a term sheet, I thought, there's a decision to be made here. A founder's coming here with a set of terms, right? Okay, it actually kind of forced us to sort of accelerate our thinking here and thinking, right, do we want to play in this game or not? Now, obviously, you may have no investors, but that's fine. It's all about generating that momentum, because obviously we know one of the biggest investors' biggest prices in this game is FOMO. Now, I'm not saying all investors, thrive and prey on FOMO, but this is going to be a real key thing, I believe, to drive the momentum around. So ultimately what I say is that doing this, being on the front foot with terms, drives investors to a decision faster. Doesn't matter whether it's a yes, doesn't matter whether it's a no. As I said, you're going to have the top of the funnel, you're going to have loads and loads of people. What you want is people to make a decision. A decision is better than no decision. Exactly. Anyway, that's enough about me talking about going on the front foot with terms. I'll go to Lily to talk about how you can structure that.
Adding one thing to that as well, I think also there's an element of just knowing what you want is really important. So again, no matter what the outcome, it's much better to know what you want than posting that, receiving a term sheet and then going, what does any of this mean? and knowing what you can push back on and what is actually totally acceptable as well. Because again, making a faux pas of pushing back on something that's pretty market standard is also not ideal. So it's just knowledge base is super important when it comes to knowing what goes into it, understanding the jargon and how it works is key. So yeah, I wanted to chat a little bit about the different methods you can take of raising. So we've spoken a lot about the equity route, which basically says, this is the value of my business, this is the price per share. If you give me X amount of money, this will buy you X amount of shares, and this is how much of the business you will own. Now that's usually what goes into a term sheet, on top of all of the other terms, like I said, economics versus control, and you've really determined quite like a fixed relationship at that point. But as the guys previously were talking about, it's not always like that, and the valuation at the beginning isn't necessarily always easy to pin down. When it's a person and an idea, like it could be worth a lot, it could be worth nothing. So this is why I wanted to talk about convertible instruments. So I wanted to cover off the convertible loan note first, purely because we just don't really see it that much in the UK. It's not super common for startups.
A lot of pre-seed and seed.
Yeah. And essentially, it's usually used as bridging finance. It matures over a period of years. It takes interest, and essentially, the investor can decide whether they want to be repaid or they will take their equity with interest as well. So essentially, they get more bang for their buck for waiting and kind of playing the long game. Now, a slightly, not necessarily shorter term version of that, but certainly more popular and more founder friendly and more straightforward is something called the SAFE, the ASA, we call it SeedFast or SeedLegals, but essentially the SAFE is the US version of it, and it literally just means simple agreement for future equity. So it does exactly what it says on the tin. The UK version of this is an advanced subscription agreement. Again, does what it says on the tin. They are subscribing in advance for shares in a future funding round. Why would somebody do this? Is a lot of the time the question I get asked. Well, essentially, the investor will get a discount on the future valuation. So essentially, for putting their capital at risk earlier, being a bit blind and not having seen terms as well, essentially you're saying, look, you can get a discount. And also, if I haven't raised around by X date, I will give you your shares for this. It's a bit like an emergency valuation. We call it the long stop valuation. So if I've not raised this other round that you're going to get a discount on, I'll give you your shares for this. And basically, the beauty of this is you don't need to wait to ring fence investors. So with an equity round, if you're looking at multiple people, let's say you've got 20 investors, you're going to have to wait for signatures. And money is of the essence. Time is of the essence of money. And basically, that can lead to a bit of a risk of a crash or a dip if you're waiting for signatures, maybe your investor's on holiday. It's not ideal. Whereas with an advanced subscription agreement, if somebody wants to give you 10 grand tomorrow, they can. And it just allows for a little bit more wiggle room and allows to play a little bit more of a strategic game. So these are always things worth noting. And the other thing I would say is SAFEs and ASAs don't kind of exclude equity, they feed into an equity round. So think of it like a starter and a main course, they do work together. And I do have a lot of people who think like, I'll just do a bunch of SAFEs, convert them outside of a round, like way later, I just won't do any of that paperwork. No. They really should feed into a shareholders agreement, some sort of more solid terms, but having that kind of undefined relationship for a short period of time is not only acceptable, but like quite useful and encouraged.
Cool.
So yeah, this brings us on to agile versus non-agile funding. So we've got a couple of graphs just to demonstrate, I suppose, what I've already spoken about. So traditional funding models essentially, I'll explain the graph. So on this axis here, we've got the working capital. So this is essentially what is in your bank at any given time. And this is the period of time that you're working on. So obviously startups usually start with a deficit. You're kind of going around negotiating term sheets. You're operating on the thin ice, and then you have a huge spike of money. You spend it, and then you're like, well, now I need to get around and start talking to people, raise these funds, wait for these signatures, deficit again, spike again. And so it's kind of that
boom or bust.
Yeah, boom or bust. And this is why this next slide kind of demonstrates the risk.
That was the bust.
So essentially, if you leave it too long, or any number of things can happen. Sometimes it can be really just not novel. What's the word? Just
think basically
unfortunate.
Yeah, with the boom and bust model, obviously, I think you're putting yourself at risk at time. I said there are many things that can hold investors up. And if you think of yourself you're on a downward slope, the further down you're getting, the kind of the weaker negotiating position that's putting you in.
Exactly.
So that's why I'll let Lily continue with how the agile funding model is, I suppose, more interesting for pre-seed and seed startups.
So essentially what you'll see, I mean, typically we would see when people use advanced subscription agreements, maybe 6 or 7 in a round of, the early stage angels who just want to kind of throw their hat in the ring and they're comfortable with it. Again, they're going to get their tax relief as well. So for them, it's like, well, let's take not necessarily a bet, very well educated bet, but essentially allows cash injections over a period of time whilst you're actually figuring out what you want your round to look like and what the value is going to be. At that point, you're no longer then working on a deficit, you're in a strong position that also buys you time to build your value. So what you do with that money is really important. Are you building a product? Are you hiring a team? And then at that point, when you are pitching to investors, you've got so much more to offer them rather than just you. So it changes the game quite significantly. And then that allows one for a larger seed round, but also much higher valuation. So yes, you've got a couple of people coming in discounted, they're getting a little bit more than maybe the others, but they've allowed you to kind of get to that point as well. Then we have the top-up element of it as well. So a lot of times these days, I've not spoken about these just because they're quite standard, but essentially a round will allow for or consent for an additional amount to be raised over a period of time. Again, this means you're not hanging around for signatures. Let's say your total target is 500K. Let's say you do 100 in advanced subscription agreements, 300 in a big raise, and then actually you can continue to top up an additional 100. Maybe people who are lagging, maybe people who are on holiday, maybe you meet an investor a week later at an event like this, and then they're like, oh, well, I wish I could have participated. Well, if you enable that top up, it's very easy for somebody to just inject cash into your business, take part, and then you can continue to do that really up until a Series A. I mean, we would recommend it's like a little bit of a circle. You do your advanced subscription agreements, you do a round, you do top ups, you stop. You do your advanced subscription agreements, you do a round, and then you stop. So it's kind of like a life cycle that means that founders aren't spending, whilst it looks like they're spending a whole time raising, it actually takes away a lot of the admin time and a lot of the kind of, I'm going to set aside 8 weeks, 10 weeks just to do a raise. This way you can be a little bit more, light.
Indeed. So look, this is actually kind of the last slide. I'm conscious we're kind of running out of time here. But we obviously talked about a lot of concepts here, so I just want to show how they're all pieced together. So this is kind of like the optimized timeline for a funding round. Now in this instance, we've just talked about, this timeline here specifically is just about a standard equity round. Obviously Lily talked about ACEs and instant investments, which kind of occur either side of this timetable. But I think the key thing is, and I've literally just saw this, I think of this when I'm sort of cooking Sunday dinner and there's multiple things to do. The first things to get done earlier, definitely submitting your advance assurance and your term sheet. Let's say your advance assurance is then in the oven, you're waiting for that to come back, and then obviously once that's done, everyone's ready to eat. The term sheet as well, that should obviously start now, get those negotiations going, because that can often be the biggest sort of part of negotiation before you get to the long forms. Simultaneously, you'll start doing those investment ready checks that Lily mentioned, so cap table, founder service agreement, all that kind of thing. Then eventually, you get to that point where everyone's signed. It's now a matter of translating those commercials into effectively the shareholders agreement. So this is going to be the legal agreement that outlines the terms of this new round. You negotiate that, money in, some closing formalities, resolutions, all that kind of stuff. And then, I've actually sat in the wrong chair, but there's a cat here which says relax. So can't take sort of general like me. Cool. So yeah, so that explains. Well, that's basically where we finish in terms of how you can use links to try around. Any questions? I don't know if we have time. No. As always, you can hop onto SeedLegals, hit on the live chat, and speak to one of our experts.
Nick, really, that was amazing. If there is any questions there, please do get in touch and we'll take them online as well. But awesome. So